Caterpillar, ticker CAT, just delivered its first $20 billion quarter and a record backlog. That sounds like proof it has become an AI infrastructure winner. But construction grew twice as fast as power and energy, while operating profit included a tariff recovery. Is Caterpillar a durable AI beneficiary, or should investors wait for a cleaner conversion? My provisional answer is watch, not a pure play re-rating. AI-linked demand is real. The view strengthens only if power and energy converts backlog into repeatable margin without depending on tariff recoveries. Start with what the headline says. Caterpillar reported $20.5 billion of second quarter sales and revenue, up 24%. Its analyst presentation showed a record $72.1 billion order backlog. Those are not weak results. The question is what created them. If Caterpillar has become a straightforward AI power company, the power and energy segment should be the dominant source of growth, and the company should be able to connect that growth clearly to data center demand. The first half of that prediction does not hold. Caterpillar's official earnings release shows construction industry sales increased 35%. Power and energy increased 17%. Construction also became slightly larger in the quarter, with about $8.3 billion of sales versus about $8.2 billion for power and energy. That does not disprove the AI thesis, it changes its shape. Inside power and energy, power generation sales increased 29%. Caterpillar said the increase came from large reciprocating engines, turbines, and related services, primarily in data center applications. That is direct company evidence that AI-related power demand is reaching Caterpillar's factories. But in its Q2 materials, Caterpillar does not disclose a complete data center revenue figure, and it does not identify how much of the total backlog belongs to AI projects. The construction segment also covers many end markets, and the release attributes its growth broadly to higher equipment sales to end users, not specifically to data centers. So, the first decision shift is this. Caterpillar has verified AI-linked exposure, but it is not a pure AI power stock. Its product portfolio can reach the build-out through two economic doors: equipment used across physical construction and engines or turbines used to power facilities, while also serving mining, oil and gas, rail, and industrial customers. The Q2 release directly confirms the power door. It does not quantify how much construction growth came from data centers. That diversification can be a strength. It can also make an AI valuation narrative harder to prove. Now, test the backlog. If the $72.1 billion backlog represents durable earnings quality, new orders should keep adding visibility, capacity should turn that work into shipments, and profit should improve without temporary support. The visibility is clearly there. The presentation shows backlog increased $9.4 billion from the first quarter and reached a record level. But backlog is not recognized revenue, and Caterpillar does not provide a full data center composition for it. The profit evidence is strong, but not perfectly clean. Reported operating profit increased 50% to about $4.3 billion. The earnings release also says that figure included $392 million of expected IEEPA tariff recoveries. That recovery is real accounting in the quarter, but it is not the same thing as recurring operating improvement. As a simple sensitivity, not a company-defined adjusted metric, removing only the disclosed recovery would leave operating profit growth at roughly 36% instead of 50%. That still represents substantial growth. It simply narrows the distance between the headline and the repeatable result. Management's own outlook reinforces the distinction. Caterpillar expects full-year sales growth in the mid to high teens, but it guides adjusted operating margin near the bottom of its target range when tariff recoveries are excluded. The company also expects roughly $3.5 billion of machinery, power, and energy capital spending in 2026 as it expands capacity. That outlook makes the next test measurable. If sales keep expanding while tariff-normalized margin stays near the bottom of the framework, volume alone is not delivering the operating leverage implied by the backlog. If margin improves as capacity ramps, the recovery concern becomes less important. The strongest bull case is that conversion is already working. Power and energy profit grew faster than sales. Its segment margin expanded, construction margin also improved, and machinery, power, and energy free cash flow reached $5.1 billion in the quarter. Caterpillar is not merely collecting orders, it is producing profit and cash while investing for more capacity. That is why this is not a pass. The remaining uncertainty is quality and repeatability. A record backlog can support years of demand, but it does not reveal the final product mix, delivery timing, manufacturing cost, or data center share. And one tariff recovery can make a strong quarter look even stronger. So what must happen next? The bull case requires power and energy sales to keep converting into profit faster than manufacturing costs rise, while the backlog remains durable after the current order surge. Full-year adjusted margin also needs to hold inside Caterpillar's target framework without depending on new tariff recoveries. The base case is where the evidence sits today. Caterpillar is a diversified industrial with verified AI-linked power demand, record backlog, and real cash generation. But the official documents do not support valuing the entire company or backlog as an AI pure play. The bear case begins if backlog growth slows before capacity converts, power and energy manufacturing costs absorb the volume benefit, or tariff-normalized margin falls below management's framework. Verdict: Caterpillar is a watch as a diversified second-order AI infrastructure beneficiary, not a pure-play AI re-rating. Monitor power and energy margin and backlog conversion without tariff help. Then, compare CAT with Eaton, where the same physical bottleneck is concentrated more directly in electrical equipment, and the margin question looks very different.